Imagine for a moment having a family fortune that, spans generations. Not just a single business, but this really complex tapestry of assets, properties, maybe philanthropic stuff too.
Mm-hmm.
How do these ultra-wealthy families protect it all, preserve it,
Yeah.
strategically pass it on, especially when it crosses borders? It's definitely not as simple as just like direct ownership, is it?
Oh, not at all. Direct ownership might seem easy up front, but it really struggles with the long-term goals of multi-generational wealth. It just doesn't have the framework,
Right. Can't handle the complexity?
Exactly. The assets, the growing family tree, different jurisdictions. It gets messy fast.
And that's exactly what we're going to dive into today. This sophisticated world of family ownership vehicles. We'll explore things like trusts, foundations, even wax. And we'll delve into family offices, what they do, and then compare how these things are treated in different places, specifically focusing on the U.S. and the UAE.
Yeah, and for this deep dive, we're drawing on some really solid sources. There's PwC's Fundamentals, Family Ownership Vehicles, Wikipedia on U.S. private foundations, some great practical insights from RSMUS on the do's and don'ts for those foundations,
Okay.
and crucially, the UAE Federal Tax Authority's guidance on taxing family foundations. So our mission really is to pull out the key insights, help you understand the what, the why, and the how of managing wealth over many, many years.
Okay, so let's start with the why. To really get why these tools exist, we need to understand the problems they solve, right? What fundamental objectives drive families to set them up in the first place?
Well, the first big one, probably the most common driver, is asset protection.
Right.
When wealth is transferred into one of these structures, it's generally no longer considered part of a person's individual estate.
Ah, so it's separate.
Exactly. Think of it like building a legal wall around those assets. It offers much stronger protection against things like, legal claims, creditors, maybe even future personal disputes. It insulates the wealth.
That makes sense. Almost like a safety net. And tied into that must be succession planning.
Absolutely critical. These vehicles let families dictate very precisely who benefits, how they benefit, and when. It's much more detailed and durable than a simple will.
Durable how?
Well, a structure like a trust or foundation can potentially exist forever in perpetuity. This stops ownership getting fragmented over generations, avoids those nightmare probate scenarios, especially if you've got beneficiaries or assets scattered across different countries.
Okay, so it keeps the original plan intact over time.
Precisely. It ensures the family's vision continues. Then there's also beneficiary protection.
What do you mean by that? Protecting them from what?
Well, sometimes family members might be vulnerable, maybe they're minors, or perhaps not equipped to handle large sums of money directly. Or think about difficult situations like a marriage breakdown.
Ah, I see.
A structure can shield those assets, protect the beneficiary's position, and safeguard them from the risks that come with holding significant wealth personally. It adds a layer of security.
Beyond just protection, are there efficiency gains? It sounds like setting them up might be complex.
It can be, initially. But long-term, they often bring real efficiency. Consolidating ownership into one vehicle can drastically cut down the number of entities, jurisdictions, and just administrative hoops you have to jump through.
So less paperwork, maybe simpler reporting.
Often, yes. Potentially reduced reporting, maybe fewer tax filings, depending on the setup, and sometimes other tax efficiencies, too. It streamlines things.
And what about philanthropy? You mentioned that earlier.
Yes, that's a huge aspect for many families. These structures can be dedicated vehicles just for holding wealth intended for charity or other good causes.
So it makes the giving more permanent.
Exactly. It ensures those long-term philanthropic goals are met year after year, generation after generation, without relying on individuals always remembering or being able to contribute. The structure itself holds that commitment.
And for the person setting it all up, the founder, I guess there's an element of control.
A very strong element. People think a will gives them control, but these vehicles offer a much deeper, more enduring level. You stipulate the terms in the legal documents, the trust deed, or foundation charter.
So you can really define how the wealth is managed.
Yes, and you might even retain some ongoing role in how it's run, perhaps on a board or council. It ensures the wealth is managed according to your wishes, not just now, but potentially long after you're gone.
Okay, that's powerful. What else?
Privacy is another big one. It often surprises people.
How so?
Well, when assets are held in the name of the trust or foundation rather than individual family members, It generally reduces the amount of personal financial information that's out there in the public domain or shared unnecessarily with authorities.
While still being legal, of course.
Oh, absolutely. All legal requirements for transparency have to be met, but it enhances personal privacy around the family's wealth.
And finally, I suppose setting clear rules helps avoid arguments later.
That's a massive benefit. Conflict prevention. A well-drafted structure clearly outlines the founder's wishes, defines who gets what roles people have, their responsibilities.
Manages expectations, basically.
Precisely. It can head off so many potential future conflicts, those really damaging family disputes over inheritance or control. So yeah, these structures aren't just legal documents. They're like blueprints for a family's future, designed to navigate challenges for generations.
That's a really interesting way to put it. Okay, so now we know why families use these. Let's unpack the types you mentioned. Trusts, foundations, WAFs. Starting with trusts.
Sure. So a trust is fundamentally an agreement. It's where one person, the settlor, transfers assets to another person or entity, the trustee.
Okay.
The trustee holds the legal ownership of those assets, but they hold it for the benefit of other people, the beneficiaries.
And the rules are in.
The rules are all laid out by the settlor in a document called the trust deed. It dictates how the assets are managed and distributed. The settlor usually makes this transfer irrevocable, meaning they give up ownership permanently.
And the trustee has a specific duty.
A very important one. A fiduciary duty. They must act in the best interests of the beneficiaries according to the terms of the trust deed. The beneficiaries then have the right to the income or capital as specified.
Where do we typically see trusts used?
They're most common in common law jurisdictions. Think UK, US, Canada, Australia. But you also see specific trust regimes set up in financial centers in the Middle East, like the DIFC in Dubai, ADGM in Abu Dhabi, and Bahrain too. They offer that framework.
Okay, so that's trusts. Now, foundations, you called them orphan entities.
That's right. It's a key distinction. A foundation is a separate legal entity, like a company, but it has no owners or shareholders. It exists independently.
An orphan. So who owns the assets then?
The foundation itself does. The founder transfers legal title of the assets to the foundation, usually irrevocably.
Ah, so the assets belong to the foundation entity.
Exactly. This structure ensures the assets are ring-fenced for the foundation's specific purpose perpetually without being tied to individual ownership.
And instead of a trustee, they have a deed.
A foundation charter. This document sets out the foundation's objects, what it's for, the powers of the council that runs it, and who the beneficiaries are, the people who can benefit, according to the charter.
So it's managed by a council, not a trustee.
Correct. An appointed foundation council manages it. They safeguard the assets and make sure the foundation sticks to its charter.
And where are foundations typically found?
They originated in civil law jurisdictions, so you see them across continental Europe, Latin America, and increasingly in those same Middle Eastern financial centers, DIFC, ADGM, and also RAICC, Ras Al Khaimah.
Interesting, okay. And the third one you mentioned was WAF. How does that fit in?
So WAF is an Islamic law concept. It's somewhat similar to a trust arrangement in principle. The founder, called the Waqif, donates property, usually forever, in perpetuity.
Donates it for a specific purpose.
Yes. The donated property is then managed by a Nazir, the WAF manager. They manage it for the benefit of others. This could be specific philanthropic causes, the community, or even designated family members.
And the rules are in a deed, too.
Yes, the terms are set out in a document called a Hijat al-Waqf. A really crucial point here is that any assets transferred into a waqf must be compliant with Sharia, Islamic law principles.
Right. So you couldn't just put any business into it, for example.
Not if the business activity itself wasn't Sharia compliant, no. And while waqfs are very commonly set up for public or charitable purposes, you also have what are called family waqfs, specifically designed for multi-generational family benefit.
Fascinating how different legal traditions tackle the same core problem of long-term wealth management. Okay, so let's say a family has chosen a vehicle, a trust, foundation. Who actually manages all the day-to-day stuff, the investments, the admin, the strategy? That sounds like a job in itself.
It absolutely is, and that's where the family office comes into the picture.
Right, we hear that term a lot. What exactly is a family office?
Well, there's no single definition, honestly, because each one is pretty unique, tailored to the specific family it serves. But at its core, it's a dedicated team, a group of professionals whose job it is to manage the family's financial and personal affairs.
Is it part of their main business or separate?
It can be either. Sometimes it's embedded within the family's operating business, other times it's a completely standalone entity.
And you hear about single and multifamily offices.
That's right. A single-family office, SFO, serves just one family, usually ultra-high net worth. A multifamily office, MFO, serves several families, often pooling resources and expertise. Both essentially exist to handle the complexity and burden that comes with significant wealth.
Why go to the expense of setting one up? It must cost a fair bit.
It does, it's an overhead. But the benefits are usually seen as outweighing the costs for these families. First, you get dedicated professionals managing very diverse affairs, investments, taxes, legal, maybe even lifestyle stuff.
Okay.
It helps centralize things, protect the family's privacy, and gives the family much greater, more coordinated control over all their holdings.
So it's about having experts on tap, basically.
Yes, and ensuring continuity. The family office helps maintain the family's legacy and values across generations. They oversee everything: the family businesses, the philanthropic activities, real estate portfolios, collections, you name it.
And I guess pooling resources in an MFO or even within an SFO's network gives better investment access.
Definitely. Better access, often better pricing on services. It provides a single point of contact to integrate all aspects of the family's wealth. It's exclusively focused on their needs and interests, and a big part of its job is managing the various risks the family faces.
What kind of roles are we talking about? Is it just investment managers?
Oh, it's much broader than just investments. Yes, wealth preservation, management, creation, asset allocation, investment management, deal sourcing, insurance, that's central.
Yeah.
But they also handle compliance and filing financial statements, tax returns, maybe payroll for staff. They manage risk implementing, professional advice, cybersecurity, keeping up with regulations. They're often heavily involved in family governance, things like succession planning, mediating family discussions, helping uphold the family's values. And then there's all the administration, bank accounts, paying bills, meticulous record keeping.
That sounds like they do almost everything.
Pretty much. And then there are often those other concierge services arranging complex travel, managing household staff, helping with the administration of the family's private foundation or charity work. It's incredibly comprehensive.
That breadth is amazing. It does raise a question, though. If you have this team managing everything, how much control do the family members actually keep? What are the boundaries? It must require a lot of trust.
That's a really important point. And establishing clear governance, reporting lines, and boundaries is crucial for a successful family office relationship. But connecting this to the bigger picture, choosing where you set up your trust or foundation is just as critical as choosing the type of vehicle itself.
Jurisdiction matters.
Hugely. The rules, regulations, tax implications, they vary enormously from country to country, even within financial centers. Understanding these differences is vital for global wealth management.
So what factors go into picking a jurisdiction?
Well, families look at several things. Accessibility is one, comes they easily travel there, time zones. Then there are existing relationships. Do they already work with trusted lawyers, bankers, or advisors there?
Makes sense.
You also have to check for any local limitations. Are there restrictions on foreigners owning certain assets, for instance? The robustness of the legal framework is key. Does it offer flexibility, strong privacy protections, good asset protection?
And reputation.
Absolutely. The reputation of the jurisdiction matters. Is it well regarded internationally? Is it properly regulated? Does it have high-quality service providers? And of course, tax efficiency is always a major consideration. What are the tax implications for the vehicle itself and for the family members receiving distributions?
Okay, let's make this concrete. Let's compare the U.S. and the UAE, starting with the U.S. private foundation context.
Yeah.
What defines that?
Okay. In the U.S., a private foundation is a specific tax classification under the IRS code, Section 501c3, for charities. Unless they can prove they qualify as a public charity, they fall into this category. They're tax exempt, but usually pay a small excise tax, currently 1.39% on their net investment income.
And characteristics. What makes something a private foundation?
Typically, it's a non-governmental, nonprofit entity. It has its own fund, managed by its own trustees or directors. Crucially, its funding usually comes from just one source, an individual, a family, or a corporation.
Unlike a public charity that gets broad public support.
Exactly. And it generally funds its activities from the earnings on its endowment and primarily makes grants to other charitable organizations rather than running its own charitable programs directly.
How are they set up?
They can be set up either as a nonprofit corporation or as a trust. The donors specify the charitable purposes, and their contributions are generally tax-deductible. They can also receive funds through things like bequests in wills.
Are there different kinds within the U.S.?
Yes, broadly 3 types. The most common are family foundations. That's not a legal term, but it's widely used. About 2/3 of U.S. private foundations are family managed. They typically make grants think of the big names like Rockefeller or the Gates Foundation.
Okay. What else?
Then you have private operating foundations. These are different because they actively conduct their own charitable activities or services. They spend most of their income on running their own programs, making few, if any, grants to others. They have to meet specific activity tests to qualify. Think of the Getty Trust running its museums.
Got it. And the third?
Corporate foundations. These are set up by companies and get most of their funding from the parent business. They're legally separate but maintain close ties with the donor company, often aligning their giving with the company's interests.
Now, there was some controversy around these historically, wasn't there? Leading to reforms.
Yes, the Tax Reform Act of 1969 really shaped the current landscape. There were concerns back then that some foundations were being used primarily for private benefit or to let families keep control over assets indefinitely while avoiding taxes.
So the rules tightened up.
Significantly. Although proponents argue strongly that foundations provide huge benefits for philanthropy. It's also interesting you see trends change reports, sometimes highlight families closing foundations due to disputes or changing priorities, while others set up new ones, maybe with time limits. And the really big ones, like Gates, undeniably wield significant influence on global policy agendas.
Okay, now this is where it gets really intricate. The U.S. rules on self-dealing. What's that about?
Yes. This is crucial for U.S. private foundations. There are very strict rules preventing almost any financial transaction between the foundation and its disqualified persons, or DPs.
Who are DPs?
Yeah.
Insiders.
Exactly. Insiders. This includes the foundation's officers, directors, trustees, substantial contributors, their family members, spouses, ancestors, children, grandchildren, great-grandchildren, and spouses of children, etc., and any companies or trusts they own more than 35% of. The idea is to prevent insiders from benefiting personally from the foundation's assets.
And the rules can be weirdly specific, right?
Very counterintuitive sometimes. Take renting property. The foundation can use property owned by a DP for free, no rent paid. But the foundation absolutely cannot rent property to a DP, even if it's at fair market value or higher.
Wow, okay. That seems backwards.
It's about preventing any possibility of the DP getting a favorable deal or private benefit. Another one, loans. The foundation can borrow money from a DP, but only if the loan is interest-free and used for charitable purposes. But it absolutely cannot lend money to a DP regardless of the interest rate charged.
So zero tolerance for potential insider gain. What about paying DPs for work?
That's allowed, but only under strict conditions. The foundation can pay reasonable compensation to a DP for services that are personal, specialized, and necessary for carrying out the foundation's exempt purpose. Think paying a director's fee, an officer's salary, or fees for professional investment management.
But not for just anything.
No. You cannot pay DPs for general overhead expenses or routine administrative tasks that aren't specialized. Again, the line is drawn at preventing indirect private benefit. Even things like charity gala tickets get complicated. The foundation can't pay for a ticket or table if a DP receives more than an incidental benefit, like attending the dinner itself. No satisfying personal pledges either.
It sounds like you need very careful advice to navigate those rules.
Absolutely essential. Mistakes can lead to significant penalty taxes.
Okay, let's switch gears completely. Let's look at the UAE Family Foundation context. You said this is newer.
Yes, the specific family foundation concept for corporate tax purposes came in with the new UAE corporate tax law effective from June 1st, 2023. It's not a distinct legal entity type like a DIFC foundation, but rather a definition used within the tax law for entities managing family wealth across generations.
And the key feature is this fiscal transparency.
That's the main point, yes. A family foundation that has its own separate legal personality, like a foundation registered in DIFC or ADGM, can apply to the Federal Tax Authority, the FTA, to be treated as fiscally transparent for tax purposes.
Like looking through it for tax.
Exactly. If it qualifies, the FTA essentially ignores the foundation itself for tax assessment and looks straight through to the beneficiaries. The income and assets are treated as if they belong directly to the beneficiaries.
What does it take to qualify?
The main condition is the no business activity condition. Generally, the foundation can't conduct a business or business activity on a commercial basis. Its activities need to be limited mostly to passive things, receiving, holding, investing, dispersing assets associated with savings and investments.
So things like managing a stock portfolio, owning rental properties.
Yes, activities like buying and selling stocks, bonds, real estate, mainly to grow value or generate passive income, are usually okay. It shouldn't be running an active commercial trade or business.
Now, you mentioned a distinction for individuals in the UAE.
This is really important. For a natural person resident in the UAE, certain types of income are specifically not considered business or business activity subject to corporate tax. This includes wages, personal investment income.
What counts as personal investment income?
That's income from investments made for your personal account, where you don't need a specific commercial license to do it. Think dividends, interest, capital gains on personal shares, and also real estate investment income from selling, leasing, or renting property, again, provided it doesn't require a commercial license.
Okay, so how does this connect back to the Transparent Family Foundation?
Well, if the family foundation is fiscally transparent, all its income, expenses, assets, liabilities are treated as belonging directly to the beneficiaries based on their share. Then you look at the tax status of each beneficiary.
So if a beneficiary is a UAE resident individual.
And the income flowing through from the foundation qualifies as their personal investment income or real estate investment income under those definitions, then that income generally wouldn't be subject to UAE corporate tax for that individual.
But what if the beneficiary is a company, a juridical person?
And then that company is generally subject to corporate tax on its share of the foundation's income, unless that income qualifies for an exemption, for example, if it's dividends received from another UAE resident company, or qualifying income from certain foreign investments.
The guidance had examples.
Yes, they help clarify. Like Foundation X holding UAE property. If it's fiscally transparent and the beneficiaries are individuals, the rental income flows to them. Since it's likely real estate investment income for them, assuming no license needed, it's likely not taxed at their level.
And the one about the trust owning a company.
Right. Trust E, an unincorporated trust, is fiscally transparent by default. If it owns Company F, which holds property, Company F itself can potentially apply to be treated as fiscally transparent too, as an unincorporated partnership.
Meaning the property income skips both the trust and the company for tax purposes.
And lands directly with the ultimate family member beneficiaries. Again, if it's real estate investment income for them, likely no corporate tax. It shows how transparency can flow through multiple tiers. It also mentions situations with multiple foundations co-owning an SPV.
And foreign tax credits.
Yes, if a fiscally transparent family foundation receives foreign income that had foreign tax withheld, that credit can potentially be passed through the beneficiaries to offset their own tax liability, if any.
So it really highlights how critical definitions are. What counts as business activity versus personal investment makes a huge difference in the UAE system.
Absolutely. Understanding those distinctions is key because the tax outcomes can be completely different depending on the classification of the income and the nature of the beneficiary.
Wow. Okay, that brings us toward the end of this really fascinating deep dive. We've covered a lot of ground, from the fundamental reasons families use ownership vehicles to the specific types like trusts, foundations, and WACs.
And the crucial role of the family office in managing everything.
Exactly. And then diving into the complexities of how regulations and tax differ across jurisdictions, contrasting the U.S. private foundation rules, especially those tricky self-dealing provisions,
Yeah, those are very specific.
with the newer UAE corporate tax approach to family foundations and fiscal transparency.
It really shows the diversity of approaches globally.
So, wrapping this up, what's the big takeaway for someone listening? What does all this mean?
I think the main takeaway is that managing significant wealth across generations is so much more than just basic financial planning or writing a will. It's this ongoing dynamic process of strategic design. Yes, designing the right structure. Then it's about careful legal navigation through complex rules and really ethical stewardship of the family's resources and legacy. It's this constant balancing act meeting the needs of the current generation while preserving and shaping the future for potentially centuries to come. And every single decision, the type of vehicle, where you locate it, how you govern it, it all molds that family's future trajectory.